Our first presentation of the day is Summer 2022 A&A Update, presented by Matt Stewart, Principal at PYA. With that, I'll hand it over to Matt.
Hey, thank you, Laura, and appreciate everybody being here, and good morning. I know we've got folks from across the country, and this is earlier in the morning for some of us than it is for others. So welcome, everybody, and thanks for starting your day out with us to go over this first session of our Summer CPE Symposium, which is an ANA update. Real quickly, there we go. Perfect. Just to give a brief introduction to myself, because I know there's a lot of folks on here who I haven't met before, but my name is Matt Stewart, and I'm an audit principal with PYA, and I'm based out of our Knoxville, Tennessee office. And just a little bit of background about me before we get started. I have an undergrad degree in accounting from Appalachian State University and a master's degree in accounting from the University of Tennessee, Knoxville. I've spent about almost 17 years now in public accounting, the first two of which were with one of the big four firms. And then the past 15 years, I have been with PYA, both in our Atlanta and Knoxville office. Primarily what I focus on in my role as an audit principal with the firm are performing audits for healthcare and healthcare related entities. So hospitals and health systems, physician groups, as well as healthcare technology companies and startup companies. And in addition to that, I'm also the principal in charge of our firm's employee benefit plan practice. So again, welcome everybody. Certainly appreciate you being here with us today. So to start off with, just wanted to go over kind of just some terms, and a lot of these are probably familiar from an auditing or accounting class you've had in the past, but if you're not living in the standards every day, then some of these may just be a good refresher. So before I go into these, really my goal with the presentation this morning over the next 50 minutes or so is just to give what I'll call kind of a general or brief overview of some of the new standards that have come out over the past couple of years. Again, I know from looking at the attendee list, we've got some other practitioners from CPA firms like myself on the line here, but we also have lots of folks who are in the healthcare industry. So my goal with this is not necessarily to go so deep into the details to where, we're talking about, debits and credits on everything and just all of the nuances of each standard. That would be a pretty lengthy presentation, and for some folks, I know it's early in the morning, that's a little bit hard to get your heads wrapped around this early in the morning. So really my goal with this is coming out of the presentation, I hope everybody just has a familiarity with the new standards that are coming out, whether they're auditing standards or accounting standards, so that, again, unless you're a practitioner, so you can be able to know really what to ask questions about of your CPA, or if it's something that you think is applicable to your organization, to be able to look into further. And certainly at the end of the presentation, my contact information will be there. If you have any questions beyond what we go over in the presentation today, certainly feel free to send us an email and we'll be happy to look at it and get back to you. So without further ado, here are the three standard setting organizations that we will be covering updates from today. The first is the AICPA, the American Institute of Certified Public Accountants. And most folks, if they are a CPA, are also a member of the AICPA. And the AICPA is the organization that is in charge of setting professional standards for the auditing profession. So if you hear your auditors use the term GAS, it's referring to Generally Accepted Auditing Standards, or GAAS, and those are the standards that govern auditors. Now also, there are accounting principles set by different boards. The Financial Accounting Standards Board, or FASB, are the ones who create Generally Accepted Accounting Principles, or GAAP, for companies and nonprofits in the United States. And then the Governmental Accounting Standards Board, or GASB, is the organization that creates GAAP for state and local governments in the US. And as you're probably familiar with, there are a lot of similarities between GAAP for governmental organizations and private as well as public companies. However, there are differences in between those two, and we'll cover a couple of those as we go through today through the presentation. So really quickly, what we will not be talking about today are single audits and the financial audits of provider relief funds. And the reason that I'm not going to be talking about those is those are certainly of such significance that we wanted to let them kind of stand by themselves and give them the VIP status, if you will, of updates. So as Laura mentioned, here later this afternoon, we will have 2 hours devoted to single audits and really focusing on the CARES Act funds and what that means for either single audits for your organization or potentially these what I'll call newer financial audits of provider relief funds and other CARES Act funds that are out there. So just wanted to let everybody know that we will not be going over these for the next few minutes, but however, we do have you covered this afternoon with several hours worth of content on these. So first off, I thought we would start with going over 2 new auditing standards that have come out over the past several years and are really just now starting to be effective for entities with years ending on December 31st of 21. And those are SAS 134, so SAS stands for Statement on Auditing Standards, and that's regarding auditor reporting and amendments, including amendments addressing disclosures in the audit of the financial statements. And we'll go over what that means more here in just a minute. And then SAS 136, which is forming an opinion and reporting on financial statements of employee benefit plans subject to Erisa, which is the Employment Retirement Income Security Act of 1974, if I remember my date right off the top of my head. So SAS 134. So the key takeaway from this, and I've bolded it up top, and if you remember nothing else about the SAS, that's okay. But the one thing probably to remember about this as the opinion is now required to go first in an audit report. And again, it's not necessarily the most earth-shattering thing that's ever been come up with, certainly, but it is a big difference in just the limited scope that we're talking about from an audit report. So it used to be that the audit opinion was, kind of back towards the back of the audit report, and usually I had to flip to the second, or even if it was a big auditor's report, even the third page to be able to get to the opinion, which is not the hardest thing in the world, but certainly that's where everybody wants to go first. I mean, you want to flip and see, okay, well, what kind of opinion did this entity get? Was it a clean opinion? Did they have some sort of modification to it? That's what I do when I get an audit report, and I would venture to guess that's probably what most people do, is they try to flip right to that opinion and find that first. So the AICPA, I think, recognized that, and they have now mandated that the opinion section is required to be the very first paragraph. So as soon as you open the audit report and get past the table of contents, the opinion section should be staring you right in the face, and you can be able to tell what kind of opinion the organization received. It also states that a basis for opinion section has to follow the opinion section, which just includes a statement that the auditor is required to be independent of the entity and to meet the auditor's other ethical responsibilities. And as we go through here, you'll notice that a lot of these, really the scope of SAS 134 that we'll talk about, and as I mentioned, there's lots of things encompassed in SAS 134, but these are really just kind of focused on some of the highlights and the key takeaways that if you are reading an audit report that you should be aware of. And really the whole purpose, or it's not the whole purpose, but a major purpose of this was just to make this auditor's report easier for folks who aren't necessarily practicing CPAs to be able to understand and read. And as we go through here, it does lay out, I think, a little bit more clearly the responsibilities both of management and the auditor. So in addition to those 2 paragraphs being mandated to be up front, the opinion section and then the basis for opinion section, it also lays out some requirements regarding enhanced reporting around going concern. And what the standards, in just a brief history lesson on going concern. So going concern obviously refers to the fact if an organization is going to be around in the future, it is a going concern. For the longest time, the accounting principles, or GAAP, didn't really speak to going concern. It was just an auditing kind of principle looking at that. Well, several years ago, the FASB revised GAAP to include this concept of going concern and try to align a little bit more closely the auditing standard on that and then the accounting principles on that. So what it says now is that management has to consider going concern from a year from the date that the financial statements are issued or available to be issued. And what that means is that, so if it's a December 31st year end, going concern isn't just evaluated through the following December 31st. it's evaluated 1 year from the date. Typically what we see is a date of the auditor's report. So just to give some practical examples, if it's a December 31st, 2022 financial statement balance sheet, the going concern doesn't have to just go through December 31st of 2023. If the audit was issued on, let's say, April 15th of 2023, it has to go through April 15th of 2024. So typically the way we look at it is it's a year and 1 day from the date of the audit report, to kind of use that hack to think of it. So what the new standard requires is that really under the old standard, under the old audit report, there really didn't have to be any mention of a going concern unless there was an issue. But now under the new standard, there is additional language included in the report that just talks about here's what going concern is and here's who's responsible for it. Ultimately, it's the responsibility of management, and then the auditor is required to audit management's assertion on that to see if they agree with it. And then, of course, consistent with kind of how it's been in the years past, if there is a substantial doubt about an entity's ability to continue as a going concern, it has to be broken out in its own section with some required communication to make that stand out. It also includes some expanded description of the auditor's responsibilities, including professional judgment and skepticism, and the auditor's communication with those charged with governance. So if you look at a new audit report, it lays out kind of a bullet point list of here's all the things that the auditor is responsible for doing. And one of the things it specifically says in there that I think is a good point to mention is that auditors are, we look for fraud and errors during an audit, but the purpose of an audit is not necessarily to find fraud. And it even goes further than that now and says that identifying fraud in the financial statements is more difficult than identifying errors, just because fraud can take a multitude of forms, and there's things like collusion that make fraud very difficult to detect. So I think that's certainly helpful for the public in reading this, because I know if I'm, talking to somebody and they find out I'm CPA, of course, the first question they ask me is, oh, well, do you do taxes, or some random tax question? And then after I have to disappoint them, about, well, no, I'm not that kind of CPA. Probably don't want me giving you tax advice. Usually if they find out I'm an auditor, they want to know if I've got any good fraud stories, which, I'm happy to talk about that. That's kind of the interesting part of the profession, I guess, to most folks. But I think this does help define responsibilities more for auditors, that, we're not necessarily able to look for all fraud, and fraud can be extremely difficult to catch. So I thought that was a good kind of clarifying comment that's been added in there now. In addition, kind of moving outside of the audit report here just a second, but auditors are now required to communicate with those charged with governance significant risks identified by the auditor. So if you've ever been to a board presentation, that should be something that your auditors, if they haven't focused on in the past, should now be touching on just the significant risks, the areas that they identified during the audit. And then the last thing here, just wanted to touch on SAS 134, is if engaged, an auditor's report can include key audit matters, or KAMS, spelled K-A-M-S for the abbreviation. But keep in mind that Gasb does not require the communication of KAMS. So this is something that for public companies has been in place. They have something called critical audit matters, CAM. So it's the same pronunciation, at least I've heard it always pronounced the same, but it's a different acronym. It's CAM as opposed to KAM. But public companies are required to disclose these critical audit matters. The auditors are required to disclose them in the audit report. Under SAS 134, unless you're a public company, the auditors are not required to disclose KAMs, key audit matters, unless we're engaged to by our client. So again, certainly just this is more anecdotal for my part, but I haven't really seen a wide adoption of clients asking for key audit matters to be included in audit reports yet. Now, whether that changes over the next several years as the standard is around longer, I guess, is to be determined. But at this point, it's not something that we've seen just lots of clients jump on right out of the gate. So kind of the last point to make on here. So right now, as far as the auditors reporting, there's kind of two differences between public companies and then what I'll just say is everybody else on the audit report. One are these KAMs that we just mentioned. So public companies are required to include these in, not-for-profits and private companies are not. Also, in a public company environment, the auditors are required to give an opinion on the entity's internal control over financial reporting. private and not-for-profits and governmental entities, we can be engaged as auditors to give an opinion, but we don't necessarily have to be. So for the most part, we are not engaged to give an opinion on internal controls. We just have to do our due diligence to look at how the internal controls are designed in order to design our audit procedures. So just wanted to mention that because those are two nuances now between public company audit reports and audit reports for what I'll call everybody else, is that public companies, the auditors are required to give an opinion on internal controls and communicate these critical audit matters. And then for everybody else, those two things are optional. All right, so SAS 136 deals with employee benefit plan audits. And if you've been in an employee benefit plan before, or assisted with the audit, or work in HR, whatever the case may be, you've probably at some point heard the term limited scope audits. Well, officially under SAS 136, that term is no more. And we'll go into a little bit of the reasons why here in just a minute and what has changed. So now they're called Erisa, and this just rolls off the tongue very nicely. Erisa Section 103A3C audits. It definitely sounds more ominous than a limited scope audit, but it's really not. It's just a change in it. However, you know, I've joked with people before, you can probably definitely get a lot more sympathy from your friends, significant others, family members, if you say that, you know, well, yeah, we're wrapping up a Erisa Section 103A3C audit, then you're wrapping up a limited scope audit. Just all the nomenclature alone sounds, you know, sounds ominous. So use that power responsibly, certainly. But what was going on that the Department of Labor found under these limited scope audits was that there was kind of a disconnect both between auditors and the public about what exactly needed to be done. Really, the purpose of the limited scope audit was to carve out the investments that were certified to by a bank or some other certifying entity, and have the auditor not have to necessarily go in and try to do fair value pricing and do determination of market value and things like that for investments. Really just kind of as a practical expedient to try to reduce the time and cost of doing employee benefit plan audits. So for example, if Bank of America was the trustee or the custodian for the benefit plan audit, they would give a certification saying that yes, to the best of our knowledge and belief, the investments and values in this report that we're giving you are complete and accurate. And so then as auditors, we could take that at face value and say, okay, we're not auditing these amounts, investments that the bank has given us. We're just going to, rely on them at face value. We're going to make sure that the financial statements agree back to them. But beyond that, we're not required to do, like I said, price testing or other things that would, add to the time and the expense of an audit. So what was happening was, I think from a practitioner standpoint, CPAs were saying, okay, well, it's limited scope audit. We're disclaiming an opinion. So, we don't necessarily have to do anything. There's not a lot of audit testing. And that was one of the things that, as the DOL kind of pulled random audit files for their sampling and their own auditing purposes, they were finding that there was some confusion, particularly among smaller firms that maybe didn't necessarily do a lot of employee benefit plan audits, as to exactly what was required of these. They were finding that there wasn't necessarily a lot of testing around contributions, distributions, things like that, that were not included in the scope of the certifying entities report and that did need to be audited. So again, I guess one thing to take away from that is, certainly employee benefit plans, even though the financial statements aren't the most complex in the world, there's a lot of regulations and nuances there. So certainly one of the things to ask a potential auditor of those is just how many employee benefit plan audits you do, because that was one of the things the Department of Labor found out, was that there was less risk of there being an audit failure the more employee benefit plan audits a firm did, which makes sense. The more you do something, the better you're going to be at it. So in kind of conjunction with that, and also just with the public reading that the auditor disclaimed an opinion on things and wondered, what exactly does that mean? Does that mean everything's okay? I don't understand. They've changed it now again to this term, this Erisa Section 103A3C audit. And it's a unique kind of classification to employee benefit plan audits. And it's no longer considered a scope limitation. So under this new standard, the auditor is required to give a opinion, or can give an opinion unless there's another reason for the modification, I should say. So what this does is in the audit report, it basically says that we're giving an opinion on the financial statements and footnotes of this benefit plan, kind of except for the amounts that are covered by the certification. And then even later on in the footnotes, it now lists out, here are the amounts that we're not giving an opinion on. And typically it's going to be those investment values, and then the like the appreciation or depreciation and the market value of those investments. But everything else is covered under opinion. So that's the big takeaway there under SAS 136 as far as the change under that new standard that wanted everybody to be aware of. Let's see, and Laura, I may get you or Matthew to help me. I think this slide may be frozen here. If you could advance it for me. Thank you. Okay, so in addition to some of those changes just to the nomenclature of the report, a couple of other key takeaways just to be aware of is that the new standard does make it more clear about management's responsibility for the financial statements, and that is included in the audit report. But management now, it's kind of codified, if you will, that management is responsible for maintaining the plan instrument, administering the plan, determining the plan's transactions are presented and disclosed appropriately, and then maintaining sufficient records. So really what this does is it puts the onus on management to say that, yes, we have all of these things, but also it puts the responsibility on management to say that, yes, we believe that this certification we're getting from our financial institution is appropriate, and auditor, you can rely on this to do an Erisa 103 A3C audit. So those are the big takeaways of that. So nothing huge as far as the operation of the plan goes, but it is going to significantly change those audit reports going forward. Let's see. Thanks. All righty. So those are the only two really auditing updates I wanted to touch on. So the rest of our time we'll spend going over some updates to accounting standards from the FASB and Gasb. And what better way to kick off an accounting update than talking about leases? So this is a virtual format, obviously, but if we were here in person, I would probably ask for a raise of hands of how many people have sat through some sort of update on the new lease standard over the past, good grief, 5-6 years. I forget exactly how long this thing has been around. I think since 2016. And I would, place pretty good money on, there being a lot of folks here that have heard a lease update. So we'll touch on this briefly this morning. This is certainly not anything we're going to spend half an hour on. Quite frankly, like I said, I think most folks have probably heard it before, but also, we can talk for 8 hours about leases and probably still, not get through everything. So this is the very condensed Cliff Notes version of the new lease standard, but it's good, I think, for us all to have an update on it, because if it's not already effective for your organization, it probably will be here pretty soon. And I've kind of put in that middle and top bullet point just when the lease standard is going to be effective for everybody. So the standard does establish two different types of leases that we'll discuss more here in just a second, an operating lease and a finance lease. But before we move on, just a very quick refresher on leases for everybody. So under what I'll just, for the sake of this presentation, call current GAAP, and I'll refer to this maybe as future GAAP, but under current GAAP, there's two types of leases. There's an operating lease and there's a capital lease. And the main difference between those is a capital lease goes on the balance sheet, you record an asset, and then you record a liability. And then as you go through the term of that lease, the asset is depreciated off. And then, of course, the lease liability is reduced as you make payments, with a portion of that going to interest expense. So the way that runs through the P&L currently for a capital lease is depreciation expense and interest expense. And then operating leases are those leases that meet the criteria to not be recognized on the balance sheet. And so those run off through the income statement through either lease expense or rent expense, or potentially some other classification, depending on how your financial statements are set up. Thanks. All right, so under the new standard, there are now finance leases. And again, the term operating leases is still there, and we'll touch on that here in a second. But here are just some of the criteria for a finance lease. And the accounting standards are moving from being a kind of a rules-based approach to being more principles-based. So what that means is that there's not necessarily as many hard and fast, black and white lines or rules as there was in the past. It's more of I said, principles based and having, kind of sticking to the spirit of something more so than trying to, have to adhere to the letter of the law. Well, what happened was, with these finance leases, when it first came out, it was sort of ambiguous about, well, what's exactly a finance lease? So the FASB, to their credit, kind of helped define a little bit of what these finance leases consist of. And as we go through these, you'll probably notice that these are very familiar to the criteria that used to be under the what I'll call the current capital leases. So again, the key concept I think to remember here is that, well, we're principles based now. So this isn't saying that it has to be this way, one or the other. These are almost more just kind of guidelines, if you will, versus the current standard where it's either in or out. This is giving a little bit of flexibility, but some of these criteria are the lease transfers ownership at the end of the lease term. That's familiar. The lease grants the lessee an option to purchase the underlying asset at the end of the lease term. That's also familiar. If you remember a bargain purchase option, a lot of times we would see at the end of the term, a lessee could buy it for $1. The lease term is for the major part of the remaining economic life of the asset, which under current GAAP, it was kind of defined as 75% or more of the life of the asset. So in similar terms here, it says, well, if it's in the last 25% of its useful life, then you don't have to recognize that as a finance lease. The present value of the lease payments equals or exceeds substantially all, which they kind of help define a little bit. That says, well, 90% would be a fair definition of substantially all of the fair value of the asset, which again is consistent with what it is under a capital lease. But this last one is a bit of a new one that says the underlying asset is of such a specialized nature that is expected to have no alternative use to the lessor. So they've added kind of a new thing to consider here is that if you have basically engaged with a company to make a piece of machinery, for example, is one of the examples I've heard before. And that piece of machinery, you're not buying it, but you're leasing it from that company. But if it's so specialized that at the end of the lease term, that company couldn't turn around and go lease it out to some other company, it's really only good for your purposes, then you have been deemed, I guess, to have substantially all of the economic value of that lease. And so therefore, you do need to treat that as a finance lease. Thank you. And then an operating lease, very succinctly, it's defined as, well, it's everything else. So if it's a lease, but it's not a finance lease, then it's an operating lease. So as we kind of go forward here, just wanted to briefly touch on the differences in how you account for those. And again, I promised I wouldn't get too deep into the debits and credits, so I'll try to make this fairly quick and painless, but it is important, I think, to realize how these come off of the financial statements, off of the balance sheet, because that is a big difference between the two. So for operating leases, let me back up here. Under both methods, you record a right of use asset while a lease liability is recorded on the balance sheet. So these right of use assets are to be separate from PP&E. So typically what we have seen folks do is kind of on the balance sheet, and there's typically a current asset depending on the use of it, but there's a right of use asset, and then and it's usually labeled either it's a operating right of use asset or a finance lease right of use asset. And then as far as how they are taken off of the balance sheet is the big difference here. So for operating leases, and again, there's of course exceptions and caveats to these, but we're just going to ignore those for the sake of brevity this morning. Certainly it's something that I advise you to look into, or certainly reach out to your CPA to discuss further if you haven't already. But for operating leases, it's typically on the straight line method going over the term of the lease. And it's run off through the income statement through either lease expense or rent expense. So there's all kinds of examples of journal entries out there, but every month you would make an entry to decrease the value of your right of use asset, decrease the value of your lease liability as payments are made, and then a portion of that goes to lease expense. So that's kind of, if you remember back from a few minutes ago, similar to how operating leases are currently, they're running through one single line item on the income statement. Is either, typically we see it as lease expense or rent expense. Now for finance leases, the accounting for that is very similar to the current capital lease criteria, to where you amortize the right of use asset. So before under capital leases, a lot of times we would see this in depreciation. Now it's technically, since it's an intangible asset, it's going through amortization, which for the most part doesn't necessarily affect anything, especially if you're thinking of like a EBITDA metric, because depreciation and amortization are both backed out. But you do amortize the right of use asset, and then as you make payments on the debt, a portion of that is going to principal to reduce the debt, and then as always, a portion of that is going to interest expense that's above and beyond the principal you're reducing. So again, fairly similar to the old method of it, but did just want to highlight those are all the leases now, unless they are 12 months or less, are supposed to go on the balance sheet. And then here's just some brief overview of how they're taken off through income. Let's see if somebody can help me with the slide, Laura, if you don't care. Oh, sorry, went too fast. Okay, really quickly. So what we just talked about was on the FASB side of things for private companies and not-for-profits. There is also a new lease standard that is getting ready to go into effect for the governmental entities. And we're getting ready to see that, I think, with a lot of our governmental entities with June 30 year ends, especially for June 30, 2022 year ends, those periods that are about to be under audit. This will be the first time that Gasb 87 is effective for governmental entities. And unlike the FASB's requirement, we joke a lot of times that it seems like the Gasb statements can be a little bit more complex than some of the FASB statements. But in this instance, the governmental statement is actually more straightforward than the FASB statement. So governmental entities are just required to have a single method for recording a lease on the balance sheet. So again, now, unless they're 12 months or less, all leases are supposed to go on the balance sheet. But at the time of the lease inception, you have a lease liability and then an intangible asset. So that's familiar with what we've seen on the from the FASB side. But then all of the leases are recognized through either amortization expense for the leased asset, and then interest expense on the lease liability, and then of course some pretty significantly expanded note disclosures just about the types of leases. But that is one nuance to keep in mind when you're trying to do if you're trying to do an apples to apples comparison between, for example, a governmental hospital and a not-for-profit health system, is that there's only one method of leases for governmental, whereas there's two for not-for-profits. So with that said, appreciate everybody's patience and attention up to this point. I think that brings us to our first polling question.
Thank you. The first polling question is, what set of accounting standards does your organization follow? FASB, GASB, SEC, or other? Remember, you must fill out the polling question in order to receive CPE credit. You will have 30 seconds to answer. Thank you for participating in our poll. Now I'll hand it back over to Matt.
All righty, well, thank you, Laura. I thought it might be interesting just to glance at the results of the poll really quickly before we move on. And again, I recognize this certainly isn't a scientific survey by any means, because there could be multiple folks from one system or another in here, but did just think it might be interesting to see kind of the breakout just at a very rough level between the different standard setters. So honestly, the poll results are kind of what I expected. The majority of folks are in a FASB accounting environment, meaning they're most likely a for-profit or not-for-profit health system. GASB's about 0.25%. SEC, of course, we aren't going over any SEC standards this morning, but that would be for public companies. And then a few others, which would be folks that are using a modified cash, or some other method called AICPA, other comprehensive basis of accounting method. So yeah, so that's interesting to see, and interesting that it kind of lined up with maybe my preconceived notion of it. So yeah, thank you, Laura. All right, so we'll continue on. We've got a couple of more polling questions as we go, but kind of moving into the next thing. Next thing I just wanted everybody to be aware of was this ASU 2021-01 reference rate reform. And again, there's only 2 bullet points I put on the slide. We're not going to take a deep dive into this by any means, but what I wanted everybody to be aware of is, if you weren't already, is that LIBOR, if I can get this acronym right, the London Interbank Offered Rate, which we see a lot of times, whether it's a lease or a line of credit or some type of debt. Typically, the interest rate we see a lot that could be tied to LIBOR. So it's kind of like prime rate. A lot of times we'll see a lease or a line of credit that's got either prime or LIBOR plus 1%, 2%, things like that, to try to set the interest rate if it's variable. Well, more time than we have on this webcast, and honestly, I don't know if I know all the history of it, but suffice it to say, I think there have been issues with LIBOR being able to be manipulated by some of the bigger banks and other investors. So LIBOR is tentatively set to end June 30th of next year. Now, whether that happens then or it gets extended further, who knows? But at some point, anyway, the intent is for LIBOR to go away. And so what that means is that any existing, contracts in place that have LIBOR are going to have to switch to some other form of interest rate. And so what this accounting standard update does is that there were certain things that had to be done from an accounting perspective if you had a document that changed interest rates in it. And really the purpose of that was to, if there was an entity that, refinanced debt or had changes in the terms of their debt, they would disclose that and then, do the appropriate accounting treatment on it. The standards as it was written was not necessarily contemplated for a widely used rate just going away. It was more tailored to, okay, well, if you individually as an entity do something, here's what you need to disclose and here's how you need to account for it. So the FASB has given some practical expedients to help, ease the transition of LIBOR going away. So key takeaways from this are, just know that LIBOR will go away at some point. If you have any sort of contract that is dependent on LIBOR, if you haven't talked to your financial institution or your lessor about that, now's probably a good time to just to make sure that there's a plan to move away from LIBOR. But the other thing is certainly check with us or with your CPA firm just about any of the accounting treatments for that to make sure that it's a smooth transition. And again, yes, just take some comfort in that it's going away for everybody. So everyone in the industry will certainly be dealing with this over the next couple of years. Next thing just to touch on, and I imagine a lot of folks have maybe heard about it already, but it's Goodwill. So a few years ago, the FASB issued a standard that said, okay, well, if you're a private company, meaning you're a physician group or somebody else that doesn't have public debt or anything like that, you can make an election to not necessarily have to do Goodwill impairment testing every year. If you want to, you can make the election to amortize Goodwill over 10 years or less on a straight line basis. You still have to test for impairment upon a triggering event, and you have the option to test for impairment at the entity level, which is a kind of a higher level, not necessarily at the operating level. So what this ASU has said is that, okay, they've also extended this option that was only for private companies. They've now extended it to not-for-profits. So that's been something we've seen a lot of our not-for-profit hospitals and health systems take into consideration about whether they want to, start amortizing their Goodwill over the course of 10 years to avoid having to do that Goodwill impairment test, and just to start bringing down some of that Goodwill value on the books and to go ahead and run it through amortization expense on the financial statements. Another Goodwill standard that's been out there is it provides an accounting alternative that allows private companies and not-for-profit organizations to perform a Goodwill triggering event assessment at the end of the reporting period. And this honestly is probably a little bit more helpful than maybe it sounds at first blush. But what had to happen in the past was, let's just say, for example, you're a December 31st year-end entity, and on July the 27th, something happened that you think, oh gosh, there was a major change. We probably need to evaluate our Goodwill for impairment. Well, it's what they figured out was, well, it's pretty hard to evaluate sometimes Goodwill for impairment on a random date in the middle of the year. There's not necessarily financial statements. We don't have the information. We don't have investment statements, things like that. So what this new standard says was that for private companies and not-for-profit organizations, now you only have to look at Goodwill impairment at the end of the reporting period. So instead of having to kind of constantly be on guard for Goodwill impairment, now you can just look at it at the end the reporting year, so basically on your balance sheet date, and do your Goodwill impairment assessment then. So we found that that's been pretty helpful to eliminate some of the headache of trying to do a Goodwill impairment test, like I said, in the middle of a kind of a random month when you don't necessarily have a lot of financial statements or information to be able to make that determination. The next one here is about government assistance. So one of the things I think a lot of us have probably had to get up to speed on pretty quickly over the past couple of years is just how to account for private companies that have received government assistance. Typically in the past, it was, unless you're a governmental entity, governmental assistance really only went to not-for-profit healthcare entities, or I'm sorry, yeah, not-for-profit entities, in particular not-for-profit healthcare entities. It wasn't necessarily going to, private companies. However, over the past couple of years, we've seen, several examples of this with the PPP loans and then the PRF monies that were kind of given out to, lots of for-profit or private companies. And the accounting standards just really didn't have anything in there that addressed for, okay, well, here is, money from the government to a private company that, if certain criteria are met, it doesn't have to be paid back. And so the AICPA and the FASB kind of scrambled to put together, just some ad hoc guidance of, okay, well, probably the best thing to do is analogize it to a not-for-profit entity, or the IFRS, the International Accounting Standards, did have some guidance in there. So it said, okay, or you can, kind of look at what IFRS does and kind of model your approach off of that. Now they've actually put into the accounting standards how this approach should be done going forward if there's future government assistance to private companies. And really it just involves information about the nature of the transactions. You should have a line item on the balance sheet and the income statement. If it's big enough, certainly probably advise you to break it out separately. But if not, then at least make sure that it's disclosed somewhere, or it can be evident to where that government assistance is. And then, of course, in the footnotes, disclose the significant terms and conditions of the transactions, including any commitments and contingencies maybe that go along with those funds. The next one is also something that was kind of born a little bit, I think, not necessarily out of the pandemic, but I think that certainly is something that a lot of us, particularly that work in healthcare, are thinking about. So not-for-profit entities are required to present contributed non-financial assets, and I put i.e. PPE, so that's not necessarily property, plant, and equipment, but more thinking about like personal protective equipment that hospitals may have received as a donation during the pandemic, as a separate line item in the statement of activities, separate from contributions of cash or other financial assets. And I won't read the rest of the slide here, but in essence, it's trying to give further clarity to, if you're a not-for-profit and you receive donations, what exactly those donations were, to have those broken out separately on the financial statements if they're material, and then in the footnotes to require some additional disclosures about those. And so the standard does give examples of what they can, what those can look like. And then I think the last one here, maybe before another polling question, is ASU 2022-03, and that's one of the few ASUs that's been issued this year. So one of the things you may have noticed is we're going through, most of these ASUs have the years that are dated in the past. Since the pandemic, the rate with which they've issued these accounting standards updates has thankfully slowed. There's been some big ones over the past few years between the revenue recognition and then certainly leases, not to mention just the fact that we've all been dealing with the pandemic, staffing shortages, everything that has come along with it. So thankfully the FASB, I think, has pumped the brakes a little bit on new accounting standards, and we really haven't seen as many this year, maybe as we have seen in years past. But one that's come out this year I just wanted to make everybody aware of is in regards to fair value measurement. And really what this is saying is that if there's contractual restriction on an equity security, so a mutual fund stock, something like that, if there's some sort of contractual restriction saying that you can't sell it or you can't do this, that, or the other, there was some confusion to whether that had to somehow be factored into the fair value of it. Does the fair value need to be lowered or discounted rather because of any type of restriction on it? Does that affect the fair value? And the FASB came out and said, no, don't worry about trying to do that. Just keep it at the value of it. Certainly if it's material, or it's a big deal, disclose it, but you don't necessarily have to go in and try to discount an equity security if it's got some sort of restriction All right, so Laura, I think that takes us to our second polling question.
Thank you. Our second polling question is, which type of firm performs an audit of your organization? Is it a Big Four firm, a mid-tier firm, a top 100 firm, a local firm, or we don't have an audit? Remember, you must fill out the polling question in order to receive CPE credit. You will have 30 seconds to answer. Thank you for participating in our poll. Now I'll hand it back over to Matt.
All righty, thank you, Laura. Well, again, I know this isn't scientific, but I just do think it's always interesting to kind of see the, the mix of what we have here on the line. So it looks like the majority of folks who have an audit use one of the Big Four firms, followed by a top 100 firm, and then mid-tier firms, and then kind of neck and neck there are local firms, or we don't have an audit. So again, this is interesting. I really didn't honestly have a good expectation of how this one would turn out. That is interesting to see. So I appreciate everybody's participation in that. So we are on the home stretch now. Just a few more slides and one more polling question, and then we'll have a short break before Mike Nichols comes on and talks to us about some of the changes and new things going on with Medicare reimbursement. But moving in kind of here in the last part of our presentation, focusing on several of the new Gasb statements that are coming out so these are only going to be applicable to governmental hospitals, governmental entities. The first one here, just wanted to mention to everybody for your awareness, is Gasb 94, which is subscription-based information technology arrangements. And there's been some similar guidance coming out over the past several years on the from the FASB for the private companies and not-for-profits. So this, in a way, sort of aligns the Gasb standards a little bit more with the FASB. But what it says is if you have a subscription-based information technology arrangement, which they abbreviate through here, SBITA, which isn't necessarily any easier to say than the full name, but in any case, it defines SBITA as a contract that conveys control of a vendor's IT software, either by itself or in a combination with tangible assets. And if it kind of sounds, well, that sounds a little bit like what we just talked about with leases. It does. It's kind of, again, looking at, what do you control, of the software? Do you have it for a portion of its useful life? So what it does is it requires governments to recognize a right to use subscription asset or an intangible asset and a corresponding liability for that. So again, if it's material, certainly would expect this to be something that would be, maybe shown separately on the financial statements as far as that intangible asset and then the subscription liability. Another one that's coming down the line is Gasb 101 on compensated absences. So really what this aims to do is kind of align all the different governmental entities on when a government should recognize the liability for these compensated absences. Honestly, I really wasn't aware of this until the standard came out and I started reading about it, but evidently there had been some I guess, disparity in practice among governmental entities about when exactly to record, a compensated absence, whether it's PTO, sick leave, things like that. So the Gasb's come out with 3 primary criteria to evaluate this against to see if it needs to be recorded as a liability on the financial statements. The first is it attributable to services already performed? Makes sense. It accumulates, and it's more likely than not to be used for time off or otherwise paid or settled. So if it meets all 3 of those, then the organization should put a liability on its financial statements for those compensated absences. Gasb 89, so this is one that's, I think, gotten a little bit of discussion going around it, at least what I've kind of heard in my circles. It's accounting for interest cost incurred before the end of a construction period. So this is something that differs between FASB and Gasb, in that the FASB, well, and Gasb up to this point, if you've taken out debt to do a capital project, so a lot of our hospital clients have maybe taken out bonds to build a new wing of a hospital or to build some sort of new facility. Well, the interest they've incurred on those debt payments during the period of construction, in the past, they were always able to be capitalized, just as part of the part of the fixed asset. And then, of course, it's subject to depreciation over the life of that asset. That's still the case for FASB, but for governmental entities, including governmental hospitals, effective for years beginning after December 15 of 2020, that's no longer allowed. Now, you don't have to go back and write off any interest that was previously capitalized, but going forward, if you've taken out bond debt to, build a new addition, to build a building, that just has to be expensed in the period it's paid. It's no longer allowed to be capitalized as part of that fixed asset. So depending on how much construction is taking place, that either could be a minimal impact or it could be certainly a significant impact. All right, and Laura, I think this takes us to our last polling question of the day, or of my session anyway, not of the day.
Thank you. Our third polling question is, which professional organization do you utilize the most for updates regarding healthcare, accounting, and finance? AICPA, Healthcare Financial Management Association, American College of Healthcare Executives, your accounting firm or auditor, or other. Remember, you must complete the polling questions in order to receive CPE credit. You will have 30 seconds to answer. Thank you for participating in our poll. Now I'll hand it back over to Matt.
All righty. Well, thank you, everybody. Like I said, that was our last polling question of this session, so we're almost through. Certainly, again, appreciate everybody's time and attention. Real quickly looking at these survey results, that's interesting. I've been involved with all of these organizations in some form or fashion in the past. Honestly, the thought the AICPA might be a little bit higher than that. The Healthcare Financial Management Association is a great resource. In the way the question is structured, I know I'm talking about healthcare, accounting, and finance, but I've been involved with the American College of Healthcare Executives for a number of years, and they're a fantastic organization, not just for healthcare finance, but for healthcare operations and things like that as well. So certainly, I guess I know I'm giving a plug for them, but I've had very good experience with all of these organizations, and then very glad to see too that there was such a high percentage of folks that are going to their accounting firm or auditors from this. I know at PYA, and I know a lot of other firms too, we like to be, the first call that our clients make, not necessarily the last call we find out during the audit. So that's terrific that it looks like so many folks have a good relationship with their accounting firm. All right, thank you, Laura. Oops, sorry, went too far. Okay, so that does conclude the end of my presentation here. So again, I really appreciate everybody's time and attention to this. If anybody has any questions on this, certainly feel free to send those in the chat. I don't think, looking at the clock, I don't think we necessarily have time right now to go over them, but certainly we would be glad to have a dialogue with you. If there's anything we can do to help, or if there's anything on here that we discussed this morning you would like to have additional information on, please feel free to let me know. But otherwise, we thank you for your attendance, and I will turn it back over to Laura to give us some instructions before our next panel. Laura.
Thank you, Matt. We will now take a short break. Our next presentation will begin at 12:05 Eastern. See you then.